ESG initiatives are driving substantial changes in business and supply chain models of multinationals, resulting in shifting of profit potential cross-border. ESG initiatives are also fostering the development of innovative products, processes, and intellectual property to enhance sustainability as well as competitiveness. Moreover, ESG considerations are altering organizations' facts and value drivers, profoundly impacting their transfer pricing. Companies are therefore required to proactively integrate ESG principles into their transfer pricing strategies to ensure alignment with broader sustainability goals and regulatory requirements. As I mentioned before, ESG consideration serve as a driving force prompting a strategic assessment of transfer pricing policies. Let's explore key instances where ESG factors necessitate this crucial review. ESG triggers a supply chain redesign, leading to revised intercompany arrangements that clearly define updated FAR. A new carbon tax like CBAM or carbon trading scheme could affect the cost structures of the products and services, necessitating adjustments to intercompany pricing policies. Companies engaged in carbon trading activities must also carefully consider the allocation of functions, assets, and risk associated with carbon trading activities. Sustainable projects frequently require obtaining green financing, which typically comes at better cost. These funds are often passed down to operating entities. Consequently, a review of intragroup funding policies, intercompany agreements, and transfer pricing documentation may be crucial to ensure accurate reflection of the distinct functional profiles of the funding entities as well as operating entities. It is essential to assess whether current framework for allocating common costs adequately addresses ESG expenses, or if a different perspective on need-benefit test is needed, which considers the broader impact on the planet and society. It is crucial to evaluate whether the benefits stemming from ESG-related effort can be identified as a separate intellectual property or are integrated within existing value chain.
The relevant markets are the carbon credits markets. The challenge here for groups is there's no one single carbon price. There's a range of prices and there's a range of markets, varying from voluntary markets to regulated compliance markets. The two main ways we see groups accounting for prices of carbon within their value chain for transfer pricing purposes and through transfer pricing policies is firstly, through a procurement function where there's one central entity that is buying credits on behalf of or for carbon emitting assets and charging a fee for that service. And then the second model is an embedded value chain where there's one entity buying the carbon credits, but then they're often buying that with a product. They're going to the carbon market, procuring carbon credits, bundling them with the product and on-selling those to the final customer as a green product. The commercial incentive for issuing green bonds is that they attract a greenium, and this is currently about 8 basis points below the typical market rate for an equivalent financial instrument that wouldn't be green. Will this increase with rising interest rates? Remains to be seen, but at the moment, a key factor groups have to think about when they are considering their transfer pricing policies is that when they are raising green bonds in capital markets and then pushing that debt down through their subsidiaries, that they are not breaching any of the conditions under the International Capital Market Association, so ICMA, that require some particular ring fencing on how green bonds are treated. To make sure bonds remain green compliant and therefore the greenium is retained, it is important that groups, when passing debt down through transfer pricing policies, consider their funding frameworks and whether any modification need to be made to those frameworks, and also updating intercompany agreements as required.
It's tricky because when constructing the functional analysis, we have to be mindful what is the contribution of ESG. Is it merely a support activity which is helping us save some costs? Is it bringing in new customers and revenue streams? Is it helping us mitigate a key business risk? Is it creating new intangibles? Is it allowing us to charge a premium in the market? Because all of these would have an impact on the arm's length compensation for the entity and consequently on the transfer pricing methodology, whether it's a transactional profit split or a cost plus or something else. So it's tricky, but very interesting. Let me give some examples. The headquarter decides to link the incentives of top executives with ESG credentials. So the management fee recharge can fluctuate year on year. But a bigger question to answer is that who should bear the cost of those incentives? The delinquent subsidiaries or those who are helping us meet ESG credentials? A second example could be reshoring. If you are reshoring manufacturing from a related party contract manufacturer because it was unable to meet ESG requirements, there could be exit tax considerations. A third example could be centralized sustainable sourcing. It could be seen as a major value-adding activity by the service provider and hence they want to charge a value-based pricing, whereas the service recipients traditionally have paid very low cost plus sourcing fees. A fourth example could be the headquarter decides to support third-party suppliers transition to renewable energy. The question is that who should bear the associated cost? The headquarter because it's a shareholder decision, or the operating in-country subsidiaries. So in short, yes, ESG will give rise to